Well, we seem to have developed a bit of a holding pattern coming through in various markets. We've got fairly defined ranges coming through in various crypto pairs. Certainly we're looking at that in Bitcoin and Ethereum. We're seeing that emerging in dollar pairs at the moment. And certainly we are seeing some heat coming out of some moves that we've seen in US equities and European equities, which have been on a blistering run. And we've seen a bit of heat coming out of the gold market, and we question whether there's more to come at the moment. Obviously, that holding pattern is fully reflective of the fact that the Fed are very much data dependent, the market's data dependent, and that data will define exactly what happens with rate cuts coming forward, and also define how we price risk as well. We're also seeing a situation where the tariff news is a moving target. Obviously, we're seeing the skew towards more positive outcomes, but we're still yet to see anything of real substance emerge. And of course, as the goalposts move and as market sentiment changes, we are looking at different trades that we like on our horizon. This is the trade-off. Well, g'day. Chris Weston here, Head of Research at Pepperstone. We're going to be discussing all the factors that are going on in this crazy world of markets. We have seen a situation where markets, the volatility has come down. We are waiting for new moves to emerge. Obviously, we are very impatient in markets. We want answers right here, right now, as to the Federal Reserve. Unfortunately, that's a situation which will take time to evolve. We are seeing a situation where Donald Trump is not just the president of the United States, but he does seem to be the quasi-president or chairman of the Federal Reserve as well, and actually quasi-CEO of most US businesses at the moment. That is the power that he wields around with the tariffs as we try and price the certainty and we try and get to an end point in that situation. Mr. Blake Morrow, I probably should have discussed all of that with you. Would you come into the programme, my good sir? The President of the United States, also the sort of shadow puppet master of the Federal Reserve. Do you buy that?
Well, puppet master.
No, that's probably the wrong word. Let's say
I don't think he has any bearing at all over Fed Chair Powell right now. Zero.
He doesn't. No, correct. I think that he is his own man. But if the Fed are waiting for data to, whether they cut rates or hold rates for a period of time, I think that really depends on companies getting the visibility around tariffs going forward. I suppose he holds all the cards around that situation. That's my point. That's what I'm trying to say.
Yeah. Okay. And and it just because you said that, I know we're gonna talk about the FOMC, which is interesting because this was a game of like, wow, did he really say that 20 times?
20 times. What, patient or wait and see?
Wait. Yeah, just like over 20 times he said that.
So you're sitting there with the Forex analytics guys, just with your checkbook. 1, 2, 3.
Actually, a couple of people actually referenced it on Twitter, so that I extracted that. But I mean, I sat there and go, I didn't trade. I literally didn't trade the entire FOMC meeting.
Yeah. Anyway, let's crack on, mate. Let's go on Topical Thunder and dissect the madness. I say the markets pulse because we're going to talk about the Fed meeting in the next little tab. Let's take a look at the market pulse here. Obviously, we have seen volatility subside. We've got the VIX trading at 22%. I like that. I think we've got a new floor in volatility now, just because of the unpredictable nature, and we haven't. Whilst we're seeing US and China, and we're actually seeing dialogue ahead of, potentially a meeting coming through in Switzerland between Scott Bessent and the Chinese representatives. Will we get any substance? Will we actually get some meat on the bone to take and go forward? Because, of course, we are trying to understand what the end goal looks like for tariffs. Businesses are trying to understand tariff rates and how that affects things like shipments. Will we see shelves in the US actually dry up? It's the end goal that we want. We are getting to the first point, which is getting these countries to the table. It looks like that's happening, which is where markets have priced. But what does an end goal look like for tariffs for a lot of these nations? And that's what we're trying to understand. And of course, economics are evolving. Like we heard from the Federal Reserve, which you're going to talk about in a second. There is a process that happens now. A lot of these companies in the US are telling survey-based situations, and we're seeing that in the soft data, that they feel a bad outcome is coming. They feel that prices paid are going up. They feel confidence is through the floor, but it doesn't mean they're necessarily going to do anything about it. There is a difference between saying something, actually coming out and starting to lay off workers. And that process may take time. Obviously, Doge are going to have effect. But we're in that period now between knowing that we're on alert that could be happen, that we could get a weaker period ahead. We suspect that's going to be the base case, but actually, will it come to fruition? And it's the data that we'll either see, a more resilient economy, or we're actually going to see fragility and labour markets deteriorating as either demand or a supply shock hits the market. And it's that period now where we are seeing volatility subside, ranges push forward. So how are you reading that dynamic?
Well, first of all, I think we have to wait and wait and
we hate
do a
waiting,
little bit
don't
more
we?
waiting.
We hate waiting. What I want answers right now.
But last week, we discussed the ranges in the market, and you mentioned it right at the beginning here. And I think you're correct in identifying that, because we are in that period of trying to figure out. And I know you want to know, and the viewers at home want to know when to trade. When do we take action? And that's the benefit of being a trader, and kind of some of the levels that we're going to be pointing out here in a minute. But I think there's some juicy setups based on where we're at and how things are going to develop here in the future, here in the next couple of weeks. And I think you are right. Seeing Besant and China, they're going to start their very, very long process of trade negotiations. And who knows how this first meeting is going to go. I'm assuming for optics reasons, they're going to tell you everything's okay. But this is a very small step in a very long process. And the markets are pretty giddy based on just talk. And I still think that there's so much in front of us that we have to dissect moving forward. So, ranges, as you pointed out, that is what we're trading. That's what we're looking at. And I think you have to be respectful of the levels we're at and trade around them, because we will be moving really soon, and the markets are going to be moving really soon. And you need to be able to take action.
But I think it's a great point. It's a great point, because depending on your time frame, if you're swing trader trading on 4 hours, or looking at daily charts, or you're taking it down a bit, the market environment that's put in front of you right here, depending on the market you're looking at, is what you're trading. Your strategy is your strategy, whether it's momentum, whether it's mean reversion, whether it's reverse, whatever it's going to be. If the market changes, the volatility comes in, ranges come in, the price action sideways chop. That is the market that's put in front of you. Does your strategy work in a sideways market? Does it work better in a trending market? If it isn't, you've got to, that's what's put in front of you. You've got to find a market that's doing what it needs to do, or you stay out because you don't have edge in that situation. So the markets are always going to be there, but it evolves right now into a sideways situation. And you just got to see, is that the conditions that my strategy works in? Does it have edge in that situation?
Right. That's exactly right. And so being adherent and understanding what market we're in. And like I said, here on the trade-off, we've kind of prepped you over the last couple of weeks, and I think we're still there. But like I said, there's some great setups, so make sure you all stick around.
If the market's not there, go and get a job in a bar for a couple of weeks, and then come back when the market's a bit more volatile. But there will be more volatility.
Get that job?
Drink the profits.
Sounds okay. Well, let's shift gears and let's talk about today's FOMC meeting, and because I know you didn't want to wait any longer, because that's all Fed Chairman Powell really illustrated today, that they're waiting on the outcome of tariffs, what's going to be the price discovery, what inflation is going to look like. I was texting with a buddy a little bit earlier. I was asking him about his 2 containers that were coming in from China. And he's like, I'm going to take delivery of them because they're only going to cost me $13,000 in tariffs per thing. And he goes, I was thinking it was going to be a lot more than that. So, but he's like, if it was going to be any more than that, I was going to hold. And you were just talking about business conditions and CEOs, they really have to take this all into account. And so does the Fed. But what's really interesting is about the dual Fed mandate. And then the question that came from the CNBC anchor, during the press conference, he says there's risk to obviously employment, but there's risk to inflation. I mean, that automatically.
He didn't use the word stagflation, but that's what he meant, right?
That is exactly what came out of my typed in our chat rooms. I was like, oh, look, stagflationary environment. And everybody's talking about,
if it smells like a rat.
Yeah, it's like it smells like it, looks like it. Yeah, it probably is it.
Yeah, exactly. Yeah.
But he's yet to see it evolve. And what the scary thing about this being looking at these 2 opposing forces coming at the Fed on the mandate, how is he going to react? How's the FOMC going to react? What are they going to tackle? Are they going to tackle inflation and hike rates, kill the economy, or are they going to lower rates, ramp up inflation, which Goldman's already seeing that's going to be probably pretty poignant. What do you do as the Fed? And by the time they react, it's probably going to be a little too late. And that's the fact of the matter. And a lot of people always like to poke fun at the Fed and say they're always late. But how are you reading what you saw out of the Fed? Because, and by the way, I do need to mention this. A lot of people recognize that the dollar actually gained strength post FOMC. And I want you all to just understand that I think that was just pure positioning. I think people were hoping he's a little bit more dovish. Some of the dollar selling just unwound. I'm assuming we're going to get right back to where we were within the next 24 hours. But anyway, how do you see everything, Chris?
Yeah, I mean, I think they just want to see. I mean, they're looking at their base cases that we're going to see a weaker economy. I mean, go back before the Fed meeting, John Williams from the New York Fed came out with a really insightful view that he believes that the US growth is going to come down below 1%, that he thinks inflation, core PCE, is going to go above 3.5% within 12 months, and we're going to see an unemployment rate that ticks up above 4.5%. Now, whether that's driven by supply issues or whether that's going to be because of lower demand, I think both of them have real big implications. But that's the base case which I think the Fed are working in. We're going to get slower growth. That is obviously the stagflation environment that we're concerned about. Now, if I have a look at market pricing, you can see 12-month forward swaps in the US are pricing inflation to reach 3.63% in 12 months' time. So again, the market may be wrong, but the anticipation is that prices and inflation is going to rise while growth goes down. And once we start seeing that manifest in the data, and look, as I said, companies are telling you that they think prices are going up. Companies are telling you that they're not confident, that CEO confidence is not there. But there's a process that needs to develop before we start seeing layoffs. And that may be shelves coming, being empty. Container ships to the US are actually increasing last couple of days. But that process is what we're trying to understand and price. And the data is going to show us. We're looking at weekly jobless claims. We're going to be obviously looking at payrolls. That's going to be the Mac Daddy of releases. We're going to be looking at durable goods. We're going to be looking at all the various factors that come into the hard data series. We're not talking about the surveys, the S&P global PMIs and bits and pieces. We already know they're weak. Right. But it actually, whether that manifests now in a deterioration in the hard data, if that happens, you are going to see markets ramp up their pricing for a June rate cut. At the moment, there's priced in about a 1 in 4 chance that we're going to get a June cut. But if any of those hard data points come in markedly weak, certainly the payrolls number, and that might not be this month, it may be the next month's series. And obviously, that's going to be perpetuated by some of the efficiency drive from Doge. 2 seconds, my mate. The market is going to go absolutely ballistic and ramp up that June meeting as a live one. We've also got to be open-minded, Blake, that we may not see a deterioration at all. What if we don't? And then prices paid goes up, and then we get a tax hit to the system, tax stimulus towards the end of the year. What happens in that situation? The market will be caught very wrong-footed. Go on, talk.
Okay, so I want to ask you a question, and what we didn't, and we probably should talk about is the fiscal situation, the new bill that. Spend bill that is going to, maybe that's going to be next week's topic. But let me ask you this really quick before we move on. What do you think the Fed's going to tackle? What do you think? And now we're obviously going to be trading the reaction of the Fed and how they respond. But what do you think in your gut? They're going to fight inflation. They're going to fight slow growth that they're faced with.
Slow growth.
Okay. All right.
I think. Okay. I think if there's a genuine, but again, it's too hard to answer that question, because if we were to see unemployment really spike up, and I don't think necessarily it's going to happen, but if we were to see unemployment going up, that's going to cause a demand problem, and prices are going up artificially because of tariffs. They'll be looking at demand and they'll cut because of demand rather than the inflation. But it really depends on their conviction on inflation. If they see it as a sort of a price rise or something that's more sustained, if inflation was going up because of wage pressures, I think that would be a bigger dynamic. But it's a conundrum which no central bank wants to be faced with stagflation. That's the worst thing you can ever be faced with. But I think if demand's falling, unemployment's rising, I think they'll take that as they'll skew their reaction function towards the growth. that part rather than the prices. I think that's my view. Do you disagree?
No, I don't. And so that probably will take us right to the next subject that you brought.
Yeah,
and
okay,
I
well,
think it's going to be a good one.
It's just, I mean, yeah, with that in mind, I mean, I don't know necessarily about any tactical trades around that stagflation, because we still, I think personally, for me, I want to, whilst it's very much on the radar, we're in markets and the Fed also, we think in outcomes. We think about the probability distribution of those outcomes, and we weight a certain probability and conviction to that. And I think, we're probably saying at the moment that the more likely scenario over time is that we're going to see weaker demand, we're going to see higher prices, and that stagflation once is there. It depends what it looks like. Is it really going to be ingrained, or is it something they can manage? I think they probably will be able to manage that. But what trades do we like at the moment? You talked about the idea that the dollar had a bit of a positioning unwind. I've got the dollar index trading 198. That's a bit of a range there, looking for that to break out. Gold had a really strong move recently, and it's just come back a little bit as markets people have looked at the US and China getting to the table. Bitcoin's trading in a range. Talk about that a little bit later on. Equities have come off a little bit after a strong run. What trades are you liking right now, Blake?
Well, I don't want to steal your thunder on one of the charts that you're going to bring, but I love you when you do pairs trades.
Right.
And I think one of the best ones would be short U.S. equities by some other market. I'm not going to give away what you're looking at, because that market I actually would agree with. So I'm not. You guys got to stick around for the trade setups. But I think as we approach the 200 DMA on the S&P, you want to be short that and maybe long, something else. I
like S&P. If we get squeezed up into 5,800, 5,850, we'll see what the world looks like in there. But I think that's the level to look at. Yeah, keep going.
Yeah. So I think that's a good one. I think the dollar can't rally no matter what. It's and we're going to talk about that too technically. I think that's a good place to be. I am a little, as far as like tactical trades, like these commodity currencies look pretty bullish, but man, if equities do roll over, I don't know if I want to be bullish, Kiwi or Aussie or Canadian dollars. I'm actually more bearish on Canada. So, I think some of those, want to be tactical, and I want to be a little bit more, going the other direction, looking the other way. I actually want to be short some of those commodity currencies.
It's a nice outside, a big reversal on the Aussie dollar last night.
Yeah, and the Kiwi too. Yeah, some big outside bearish outside day candles. So what do you think technical wise?
I like the long short strategy now. I do like the idea of buying volatility below 20%. 18% is our year to date average on the VIX. If we mean revert back to those levels, then I think there'll be an opportunity there, because what that does is encapsulates goodwill. I still think while we're hearing noises of China and the US getting to the table, it's still a long slog. I think you mentioned it earlier that to actually have an agreement that brings down the tariff rates from 145% down to, say, 50% is still a long way. And then you're still going to get, goods going out to the US and goods going from the US to China as well. So, there's no guarantee that's going to happen. So I think get down to those levels. I think there's a new floor in volatility. And it probably marries up with the S&P getting into that 5,800, 5,850, which there's no guarantee it's going to get there, but I think that would be a key level to look at if we get there and see how the market reacts. So, but I think long short's a great way to play this. You just in a world of uncertainty and headline risk, you're just looking at relative plays rather than just trading headlines. And I think that's the way that I've been certainly looking at different markets as well. So we can talk about those in a bit.
Yeah, smart. All right. Well, the last topic that I want to talk about is just we have the Norges Central Bank. I think the Riksbank also tomorrow morning, but we also have the Bank of England. And the reason why I wanted to talk about this is if you guys, and I'm talking to you, Ryan and Michael, if you don't think I listen to your show, I do. And Ryan said something really interesting on the UK trade-off show. He said that in the UK they're a little bit more. The inflation tends to be a little bit more sticky. Tends to be a little bit more. The Bank of England pays attention to it, and so does the UK citizens, for that matter. But the Bank of England is tomorrow, and the market's coming in with a pretty dovish stance. I mean, three cuts going into the remainder of the year, possibly 4. And the bank and talking about a range, the sterling's at the 132 to 134.30, 134.40 range. We're near the lower end of the range, near 133. And I think the risk is for maybe an even a more hawkish surprise. And I kind of wonder, can you get more dovish on the Bank of England at this point? And I'm sure Michael Brown would probably argue that you could. But I like where it sits relative to where the dollar's at across the board. I think the dollar still looks like we're going to see some weakness. The Bank of England might be a little bit more hawkish, and I think that the sterling might be a buy somewhere down here below 133 that we currently trade at the time of filming. How do you feel about the Bank of England tomorrow, Chris?
Yeah, well, I mean, they're going to cut. I think that's yeah, it's absolutely a done deal. You'd be falling off your chair if they didn't cut rates in this situation, and the market would, the pound would get absolutely crushed, or rally very, very strongly, should we say, if they didn't cut rates. But the question you've got to ask yourself is what's the split going to be in the voting? We're going to see at least two members there, Dingra and probably Catherine Mann, calling for a 50 basis point cut at this one. There might be even one more coming through as well. So, I think that's that. It's not really a question of whether they cut rates. It's a question of the appetite to cut rates in the July meeting. In the June meeting as well. Now that's priced at a 58% probability that they do back-to-back cuts. So we've got to look at the statement. We've got to look at what they're saying, and do they show that appetite to go again? And then I think that's what we're looking at. But also further out the curve, as you talk about, we're pricing 92 basis points for the end of the year. That includes this cut. So we're going to get this cut, and there could be another 3 cuts. And we're verging on that idea of 3 cuts. So it feeds your point. Will they outdove a dovishly positioned market? And that's where we could see some initial volatility. Whether we see that probably more defined against the euro and against the crosses is probably the case. You probably get some big moving cable, but I think once that settles down and we get a sort of a fair value in rates pricing, then it becomes more of a dollar move than that in cable. But yeah, if you want to trade that initial move in rates, the question is we got 58% chance that they go in a second one. Will they give that definition they want to go again? The fact that there's going to be at least 2 members calling for 50 at this one suggests that could be the case. And then will they give that conjecture that they're really keen on getting the cash rate or the bank rate down hard? What that terminal rate looks like. That's where we're going to reconcile the statement against what's the 90 odd basis points that are priced into the curve, to get that. So that's going to be something that could cause an initial bit of volatility in the pound for sure. Something to be aware of if you're running those pound positions. Anyway, let's go into that's the setup. Let's go to the Germany 40. Let's go to the DAX because there's been so much focus on what's been happening in the S&P, what's been happening in the NASDAQ, which has been obviously a very strong performer since those April lows. The technical bull market we've been seeing, but we have seen under the radar, which has also been having earnings coming through in Europe, and they've been reasonably okay. Again, not as many as you'd want to giving that out guidance. But you have seen European equity markets having an absolute ripper, as we say, down under. And, the DAX has pushed up just shy of all-time highs. It's pretty much consolidating around those regions. At the moment, we can see pullbacks are supported into the short-term moving averages. But I think, the DAX now from those lows up about 25% or so in euro terms. Now, the interesting thing is that we have seen outperformance of the European equity markets, even, throughout these periods, even if you price them in, put the DAX into US dollar terms. And I don't see anything in the flow data that says people are really sort of, just calling an end of US exceptionalism, especially now that Nvidia looks actually quite bullish, and that may rally going into the earnings situation. But look, I think this is a setup which needs looking at because it does get less attention, but this is a market that's testing all-time highs. And, regardless if you just take a step back from what's actually happening in this crazy world, you can't really get anything more bullish than a market at all-time highs. The question is, will it push through that 23,500 and kick after such a good run? That may be hard to do. Or is this the level now to start initiating shorts? But it's a setup that's worth looking at.
It sure is. And it sure is outperforming the U.S. markets. And that's one of the ones that I had my eye on. We were talking about, what are those tactical type of trades. So my first setup is going to be the Aussie yen. And I actually talked about this last week. I was looking for a break above the 92.10 level, that green line, and we got that breakout, but it was very, very limited upside. But what we did is we ran into this descending trend line, and Now I'm looking actually short against that trend line. So, you get me up around 93 yen, and I'm actually looking to be short some of these commodity currencies like the Aussie yen. While that, and I have to mention the reversal that we saw in the yen last week following the BOJ, which in my opinion, we should have been trading close to 148 versus reversing above 145, close to 146 and coming right back down to 142 and change. I did not expect that, and I don't think the market really did either. It was enough to squeeze out some yen longs, some stale yen longs, and we'll see in the CFTC data at the end of the week. But at this point in time, I think while we're below 94 yen, I am looking to be on the short side. Obviously, if there's a deal to be had and something great happens between Besant and his Chinese counterpart in China over the weekend, maybe this is a setup for an upside breakout next week on Monday, Sunday, Monday, if there's some good news flow, positive news flow that comes out of the China-US meeting over the weekend. Where are they meeting? They're meeting in Switzerland, that's right, which makes total sense. Anyway, the Aussie yen, in my opinion, is a great setup here for a short, but you can also think about it for a stop and reverse long as well.
Interesting that we didn't see any reaction in the Aussie to China coming out and cutting the loan prime rate or the reserve ratio requirement. And for me, that's quite a precarious situation in China because their banking system is not profitable with net interest margins at these current levels, and they're getting support from the central bank as a result. So coming out and cutting the loan prime rate so people can get a cheaper cost of capital is great for the consumer, and it's pushing people out the risk curve. But we need to see volumes pick up for them to try and make profitable. Otherwise, they're just going to be their net interest margins at but 1.6% are still too low for the banking system. But we didn't really see any real pop. And again, we are watching that Chinese currency very, very closely at the moment. That's a lot stronger than most people had anticipated, which has been supporting the Australian dollar to an extent. So we'll see. We keep watching a lot of these Asian countries. We've obviously seen big moves coming through in the Taiwanese dollar. The Hong Kong dollar's been defending a peg. With Singapore dollar's been moving, and China as well. I think you've got to keep an eye on that the Chinese yuan. But the failure to move on Chinese easing was quite interesting. Anyway, let's go to WTI Crude because that has been quite interesting of late. We came down to the April lows. The bulls stepped in. We've obviously got a very, very defined range. Or we know where our risk is if you want to be long in that situation, because a close below $56 would obviously be very telling. Now, I will say that there was a survey done by the Dallas Fed who came out and surveyed 81 different onshore producers in the US, and they talked about whether you're Eagle Ford or whatever the onshore oil field is. If you're looking at existing wells in the US relative to new wells, obviously it's more expensive to bring on new capacity to the market through new wells. But if you're looking at the existing ones, through the various functions that you're seeing, these 81 companies said their average break-even rate to be profitable is around $41 for WTI. Now that obviously changes. The scale is obviously different. But as we were to break $56, what we do is we run into a situation where a lot of these onshore producers will become less profitable. And what you'll start seeing is a number of them coming out and talking about that, the idea about potential production cuts. And that should slow the rate of change on any selling for a break of $56. But from a trading perspective, it's pretty clear that there is very strong support below $56. From a fundamental perspective, we've obviously heard from OPEC and the threat from the Saudis, who seem to be sort of looking to bring everyone back in line, who have been producing more than they were expected to do, shows that OPEC is a little bit fractured at the moment. Do we get that breakthrough $56? On a closing basis, I think that would be very, very important indeed. But it would then take us down into an idea where a lot of these onshore producers will start talking quite liberally about cutting back on production. So it's a great setup for me.
All right. What a great setup. And that 50, 55, $56, what a big level.
Indeed.
My setup, my last setup is going to be the EURCAD. And as I alluded to earlier, I'm bearish on Canada. We've got Mark Carney, who has done the global
the rounds.
What do they call it? The Chinese fire drill when everybody gets out of the car and takes different seats and stuff. He's really taken the helm of the Bank of England, the Bank of Canada.
I think the word you're looking for was mercenary.
Mercenary, yes. And so now he's in Canada, and now that we've got you could call it the Carney bump or whatever. I'm not necessarily I don't want to buy the dollar CAD. That's what I don't want to do. I don't want to be long dollars, but the dollar CAD is getting close to some really critical support. Like it's a big channel, descending channel. And I think around 137 to 136.50, if we see some extended dollar weakness, if the euro pushes back up towards 115, the dollar Canadian is probably going to drop down towards that 137, 136.50 level. And if it does, I'm actually going to be long the euro Canadian on this channel support. That level that I'm looking at is actually the 78% retracement, and that's going to be below the 50 DMA. I think if we get below that, it's going to open up a little bit of downside. But if we can get long closer to 155, 154.80, that's going to be the level for me. I'm actually looking to get on the long side. I'm going to have some orders sitting out there, Chris, because ultimately, I think Canada is going to be one of the recipients from a negative point of view.
Have that. Trump would be loving you right now, to be honest. But Mark Carney's one of those guys, isn't it? You've set up a very successful Forex analytics firm. I won my first futsal game on the weekend. But Mark Carney, we love him or hate him. I mean, he's got a story to tell his grandkids one day, isn't he? Head of Bank of England.
Sure does.
He's got a pretty decent CV. Stories to tell. Anyway, let's go to play of the day. All right, I'm going to go for Bitcoin. It's actually not a play. This is one that I've been sort of banging the drum about pretty liberally recently, and it's not been right. It's been sort of half right. But now we're in a situation where it's very much on the watch list. I've got my alert sets. You can see that this has been a range trade. Which actually was a setup that we talked about last week where we're talking about playing the range. But now we're banging the upside of that. Now, what I will say is that the 20-day rolling correlation between Bitcoin and S&P futures is at 81% at the moment. So obviously those relationships break down and they come and go. But we are looking, if we were to see S&P futures push up through those recent highs, make a higher high and actually sort of maybe make a stab back into sort of 5,800, 5,850, that would see, if that relationship holds, then that should see a new high coming through in Bitcoin. That should then take it through to 100,000. Now, unlike what we saw in January where it spent half the month above 100,000, there was a lot of stigma around that. We saw a lot of the order book very much stacked on the sell side, going into 100,000. But I think the stigma has been taken away because the fact that we spent such a long period of time through January in that situation. I think I've got my orders set. I'm going to be looking to do a buy stop order through those highs. Certainly add to that position if we can get a daily close, and depending what that candle looks like, if we can get a price close to the highs, obviously that's a good thing. And I think we go through to 100,000. I think we push. It's obviously not a big call given there's only 2,000 points away, and that would obviously you wouldn't take too long, and it would be a bit of wood to chop. But I think we get 100,000. I do like some of the fundamentals that we're seeing. Obviously, what we're seeing in S&P is important, but we are seeing certain states in the US, such as New Hampshire, now actually coming out and allowing the state treasurer to invest in Bitcoin and 5% of the fund into digital assets. And I think that's a thematic that will come across other different, more progressive states as well. So we'll see what happens. But I like the break. I want to trade it from the upside.
That should end well. That's going to be awesome. All right. Well, I like Bitcoin. I actually think it rallies to 102,000, Chris. So I'm going to call your 100,000 and give you a 100 and
he's got pocket aces, hopefully.
All right. So my play of the day is going to be the dollar. This is, the dollar bears, the dollar bulls, they had their chance for a recovery. They fumbled it. And we have a bear flag developing. I call it the white flag is being waved right now. Bulls are raising that white flag and they're going to give it up. So the euro dollar, there are certain pairs that I'd prefer to trade being short the dollar, and euro would be one of them. US dollar Norway, US dollar Swedish krona. You got the SEK, the NOK, and you got the Norges Central Bank and the Riksbank both tomorrow morning. I actually even like the dollar yen to the short side. So there are ways that I'd like to trade the dollar to the short side, and those are some of them. Even sterling, as I talked a little bit earlier, if we can have a Bank of England that's a little bit more hawkish tomorrow. But anyway, a break below that flag support, which would put us in a new weekly low below 99, 98, 90, somewhere around that level, would take on 98, and eventually, and you can see where the flag actually targets. It targets a long-term 161% extension of basically the 2024 range. So that's all the way down in the low 90s. And if you want to do some math with the euro, that probably puts the euro closer to 120. Yeah. So realistically, that if that flag pattern starts playing out, that's probably going to be our target as we head into fall this year.
And you'll be taking it to those dollar bulls. Take it to them, Blake. Yeah. I can't give any love to the pound. One, because the place is burning and it's deteriorating before my very eyes. But secondly, Arsenal lost last night. So I think just selling the pound alone on that situation is worth doing. Anyway, thank you, Blake. Thanks for your thoughts. Thanks for your insights. And for everyone at home, thank you for sticking around and hopefully enjoyed the show. Leave a comment, smash the like button. See you back next week for more.